The coronavirus has infected thousands worldwide and started to impact not only the global markets, but the markets here at home as well. In this week's video, we're going to dig deep into what exactly the coronavirus is and what concerns for the market we may have, as well as some downside targets on the S&P 500 if the sell-off continues.
As Matt just mentioned, the coronavirus affected the U.S. markets last week as the Russell 2000 was down over 2%, the Dow Jones was down about 1.2%, the S&P 500 down around 1%, and the NASDAQ was down 0.78%. Now the NASDAQ is still positive and it's up almost 4% for the year so far, but the Russell 2000 is now negative, down just under 0.5%. Foreign and emerging markets were both negative last week, with foreign markets down about 1.2%, and now foreign markets are about flat for the year. But the coronavirus mainly affected China's stock market, which is part of the emerging markets, as emerging markets were down over 3.5% last week, and now emerging markets are down 0.6% year to date. With the recent coronavirus scares trickling into the U.S. markets, we wanted to take a look at the S&P 500, where it currently is, as well as some downside targets and some important support levels that we're paying attention to just in case this sell-off continues. So if you're looking at the chart, right through the middle you'll see the blue straight line, and that's the thicker line that was the breakout level from November of 2019. Now right below that you'll also see the rising thin blue line, and that is the 200-day moving average. And if you look to the far right of the chart, these two lines are getting very close to each other. Now when this happens, that makes these support levels even more important. And this level that we're looking at and paying attention to now is right around 3,025 to 3,030 on the S&P 500. Now as we're shooting this video, it's Monday morning. The market's opened up down about 1.5%. So we're still watching these downside levels and these downside targets very closely, as that breakout level from November of 2019 is about 7% away from where we currently are, and that 200-day moving average line is about 7.5% away from, as we're shooting this video on Monday morning, where the current S&P 500 level is. Now with that being said, a normal back test back to that breakout line from November of 2019 wouldn't necessarily be a bad thing, as long as the S&P 500 bounced and continued higher from there. But if we see a continuation down below that breakout level and continuously down through the 200-day moving average, that could spell bad news for the markets for the rest of 2020.
First, I wanted to go over what exactly the coronavirus is. And the coronavirus is a flu and cold-like virus that gives you similar symptoms to having the cold and flu, but it's more dangerous because this settles in your chest and can cause pneumonia. Now, the new coronavirus, which is known as 2019-nCoV, or the Wuhan coronavirus, has not been fully studied yet. But early indications are that it transmits from human to human like the flu virus. A similar coronavirus that caused this much concern was SARS back in 2002-2003. And like SARS, this strain infects the lungs, which makes it more dangerous. But something that's a little different with this virus is that it seems to be able to be transmitted even though you do not have any symptoms. So you could infect everyone around you without even knowing it. While news keeps breaking, it's very tough to figure out exactly how many people are actually infected worldwide. But the most current numbers that we could find, there's about 2,000 people affected worldwide, about 80 deaths, and now it looks like there's about 6 people that are infected here in the United States, with the 6th case just being reported here in Pennsylvania at the William Penn Charter School in Philadelphia. Currently there are 18 cities in China with varying quarantine restrictions, and 4 of them are on complete lockdown. These quarantines are affecting about 56 million people. We now wanted to take a look back to see how the stock market was affected during the SARS outbreak back in 2003. And the US markets really weren't affected by this, but the Chinese markets did sell off about 8%. Now, if we take a look at the Chinese markets now, they're currently down about 8% from their highs before the coronavirus outbreak. One thing that is different now versus then is that we're now running into the Chinese New Year, which is the biggest spending time in China and accounts for over 10% of their nation's GDP. So that's something that could drastically affect the markets if people are not out celebrating and spending. In China right now, they're looking to extend the Lunar New Year celebration into the future if their outbreak continues.
There are three things that we're paying close attention to this week. First, obviously, we're going to follow everything that's going on with the coronavirus. Second, there's about 30% of the S&P 500 companies reporting their earnings from the fourth quarter of last year.
And lastly, we have a Fed meeting this week. Now, we're not too interested as to what they're going to do with interest rates, but what we want to see is the language that they have surrounding their balance sheet, as the market's been directly correlated with their spending over the past year. Thanks for watching, and make sure you subscribe and hit the notification bell.